Hi, welcome back to the channel. Hope everybody's doing good. It's hard to believe that December is back around here once again. This month I've got another 3 UK stocks which I think look like good buys heading into December. Before we start, the channel is so close to reaching 100 subscribers. All I ask, if you get a little bit of value out of this video and enjoy the channel, please drop it a like and subscribe, and I really appreciate all the support so far. First stock we have here is Vodafone, which hasn't been without its headwinds in the last few years, resulting in the share price free falling. Things may be changing with the new CEO, Nick Reed, in charge, who took over the reins in 2018. Vodafone, if you don't already know, are a huge telecommunications company operating in two main areas, which are fixed lines and mobile services. They do also offer business-to-business services as well. Their main footprint is within Europe, but they do have a growing presence in South Africa, which is one of their main areas for growth. In terms of financial results, they've been really struggling for quite some time now. 2019 was a disastrous year with the company's revenue dropping alongside reporting a huge loss well over €8 billion. Balance sheet wise, total assets do outweigh total liabilities. The hanging grey cloud over it all is the large amount of debt on the balance sheet. From 2018 to 2020, this nearly doubled from 43.2 billion to nearly 75 billion, which is an obscene amount of money. The one positive area is that they did bring this down a bit to €66.7 billion for full year 2021. The turnaround play can be seen in these forecasts, which still show that 8 billion loss in 2019, but the company is expected to return to growth in 2022 and beyond, with revenue and earnings both following a positive outlook out to 2024. Insider trading isn't something I fully base my investment decisions upon, but it still adds some food for thought on what people within Vodafone or within the boardroom are doing in regards to insider buying and selling. Clara Fursey, who is an independent non-executive director and had been on the board since 2014, picked up nearly 87k worth of stock, followed by Maria Martinez, who also bought and sold 35k worth in the same day, which is a little bit odd, and it's just 2 days after the company reported earnings. Nick Reed, the man with a plan, has been with Vodafone since 2014, and in October 2018 he stepped up to become the CEO. He's been on the board of various telecoms companies, mainly related to Vodafone in Qatar, India and Egypt, as well as VHA in Australia and Indus Towers in India. He holds a non-executive director role at Bookings Holding, and he has done since 2018. In 2019, he made the decision to cut Vodafone's dividend, ending a 2-decade streak of rising payouts in order to strengthen the balance sheet. As you can imagine, the share price continued to slide, falling 5% on that one day alone. Another decision that Nick has made, and this may be due to his experience with Indus Towers, he decided to spin off their tower assets into Vantage Towers to trade as an independent company, with Vodafone getting €2.3 billion in the proceeds, and highlighted I've got it mentioning that this was then used to pay down the debt. From these two decisions, it can clearly be seen how much the new CEO is wanting to clean up the company's balance sheet. Vantage Towers, over the course of the last 6 months or so since its IPO, has been pretty range bound, fluctuating between €28 and €31 per share, with a current market cap of about $14.72 billion. Vodafone released earnings just last week, and it had some positive news within it. Firstly, they raised the lower band of earnings guidance to $15.2 billion, up from $15 billion, with the upper range remaining the same of 15.4. Free cash flow target was increased to at least 5.3 billion, up from 5.2 billion. Total revenue growth came in at 5% growth, up to €22.5 billion. Pre-tax profit did fall from 1.93 billion last year to 1.28 billion this year. But all in all, I think there's a few positive catalysts here for the short to medium term. Looking into the earnings reports, we can see the return to growth in the service category. Adjusted EBITDA growth is the best it's been in 4 years. Return on capital employed is at the same levels as the second half of 2020 and showing consistent improvement from the first half of 2021. Down at the very bottom of the slide, the dividend has been held at 4.5 cents. The reported growth in the service revenue is contributed by the growth in Europe, which is a mature market, as well as growth in South Africa, which does look to have slowed down a bit from the last few quarters, where it was growing between 5 to 7%. Consumer sales have shown steady growth over the last 6 to 7 months, almost back to pre-COVID levels. Germany, which makes up 38% of the group's earnings, reports steady numbers with service revenue of 1.2%, with adjusted EBITDA of 7.7%, and in 2019 Vodafone purchased Unity Media, which provides cable services within Germany, Czech Republic, Hungary and Romania, with results now showing mobile contracts back to growth after 2 quarters of reductions. Cable additions are also picking up in the last quarter after previously slowing. Performance in Italy has been really struggling, with constant losses of revenue ranging between 6 and 8%. It has started to pick up in the latest results, showing a loss of 1.4%, but adjusted EBITDA improving 14.7%. The UK had good commercial momentum with service revenue of 1.2% and adjusted EBITDA of 1.8%. Net additions has been slowing, but with deals in place with Openreach and CityFibre, this should provide growth in the coming quarters. Mobile additions have shown a huge jump up in recent quarters, with the second best quarter within the year. In Spain, cord cutting is still evident, with continuous losses in fixed broadband in a highly competitive market, but mobile additions remain strong, with accelerated growth between quarters. Overall service growth and EBITDA both reporting a loss of 0.6%. The remaining areas of Europe show good numbers, with revenue up 3.3% and EBITDA up 4.5%, making a strong turnaround from the losses previously recorded. In South Africa, growth has been solid, with 5.4% service growth and adjusted EBITDA growth of 5.6%. One of the interesting avenues that Vodafone are taking in South Africa is that they have a fintech platform called M-Pesa, which reports impressive growth in the monthly transactions from $12.5 billion in full year 19 to $26.8 billion in full year 2022. And Vodafone Ziggo, which is a 50% joint venture, is shuffling along nicely with consistent growth numbers. And this is what all this information translates into: raised guidance up from the lower limits. All areas, with the exception of Spain, look to be making strides in turning the ship around and returning to growth. With the so far so good leadership decisions taken by Nick Reid, it might look like this telecoms giant is back in safe hands, and it's a compelling turnaround play in my opinion. Vodafone's share price has been coming down since its 52-week high back in May-June time. It's had a good bounce from the £1.10 mark when earnings were released, so this could be the start of some positive momentum. The yield right now, if you want to pick up this company, is about 6.6%, which is a huge yield, and it could be good to see this coming through the door until the share price recovers. Analysts are bullish on the stock, with 24 analysts coming to the mean consensus that it should have a buy rating, 15 have it with a buy, 7 outperform, with 1 each for underperform, sell, and 1 without an opinion. The average price target is €1.95, giving a huge jump of nearly 51% from current prices. Stock number 2 is a high growth, high risk name, and this is Darktrace, who are a UK based cybersecurity company who utilise AI to track and neutralise cyber attacks. It provides services across a vast array of industries such as financial services, manufacturing and supply, education, retail, health. Every industry that you can think of, Darktrace has the potential to be involved within, due to every company requiring some sort of online presence for storing data. Although it's UK based, almost half of its revenue is from the US and Canada, where 41% of revenue in 2020 came from, and then we have 21% with the rest of the world, and the UK and Europe both with 19% each. The growth within this company can be seen in the huge jump up each year from £80 million back in 2018 to £280 million in 2021. This year did have its largest loss reported, coming in at £150 million, with £103 million of that due to the cost associated with 2 convertible loans converted and eliminated at the time of IPO. They do have a strong balance sheet, with assets outweighing liabilities. They're sitting on £342 million in cash and £35 million of net debt, providing plenty of cash to fund growth drivers and also support them on the path to profitability. This company's growth forecast out to 2024 show that it's expected to be hitting $640 million, and this section is within dollars as opposed to pounds. So there is plenty of hype around where this company is heading, although even out to 2024, Darktrace still isn't expected to be reporting a profit. Vanessa Colomar, who sits on the board of directors, has been heavily selling this stock, selling more than £9 million worth of stock, which is a huge sum of money, and is more than likely one of the reasons why this share price has been declining in recent months. We don't know why she sold her shares, and there could be 100 reasons for it, and the share price, to be fair, has been declining since October, so maybe she wanted to take the money in anticipation that this share price was going to keep on falling. Who knows? On the other hand, we have Gordon Hurst, who picked up nearly 150k worth of shares at a price of £5.96. Darktrace are spearheaded by 2 women who go by the names of Poppy Gustafsson, who is the current CEO and has been with them for 16 years since their inception, and Kathy Graham, who is the CFO, joined them only last year. I like the balance they've got here of having someone who's been here since day one, and then they've also got someone new who can help keep things balanced at a senior level. In regards to full year 2021 milestones, Darktrace reported 46% constant currency annual recurring revenue growth, 41% year-over-year revenue growth, 45% increase in customers from 3,850 to 5,600. They closed their largest ever deal, and they've got $1 million plus in Antigena email deal. Employee headcount increasing from 1,150 to 1,600, and 48% growth within the research and development team. The performance has been strong, with 77% of Darktrace trial deployments detecting serious threats others have missed by using their self-learning, rapidly adapting AI. In recent years, we know how frequent and how damaging cyberware attacks can be, which gives this company a huge platform to succeed. Of course, we strongly remember the SolarWinds hack, where hackers were able to penetrate SolarWinds system and get a hold of sensitive data, and this spread onto some of their top clients with the likes of Microsoft. So the importance of having these cybersecurity companies in place like Darktrace is only going to grow. We've previously explored their growth in revenue, most years growing 40 to 50%, and what I love the look of here is that 99.5% of their revenue is recurring and based from a subscription-based model, meaning constant cash flow back into the company, and in my opinion, these models work better than an upfront one-off cost. Their customer base has been growing to the same tune, reporting 40 to 50% growth in most years, and now they have over 4,818 customers with an annual recurring revenue of up to 100k, and 787 customers with more than 100k in annual recurring revenue. When you see the huge jumps from where this company was in 2018, you can now start to see why the growth estimates are through the roof. This extract shows the key cost movements to help show us where the company is spending their money. When a company has such high growth rates of 40% plus, you can see how money needs to be ploughed back in to keep up with demand, bring on staff, invest back into research and development, pay any debt, etc. Overall, if we focus to the bottom, we get the overall picture that the loss jumped from $28.6 million to $150 million, and this includes that $107 million payment that we talked about that they converted at the time of IPO. And I know I keep on saying it, the growth, but with a total addressable market of potentially up to $125 billion, and with the potential for up to 150,000 customers who could use Darktrace, the sky really is the limit, and buying and holding this company for a long period of time, it could show some mouth-watering returns. In terms of guidance, they have increased guidance up to 35 to 37% revenue growth, up from 29 to 32% given back in July. Year over year constant currency annual recurring revenue growth up to 34 to 36%, and net constant currency annual recurring revenue added is to be between 12 to 14%, and adjusted EBITDA margin to be between 2 and 5%, up from 1 to 4%. So a lot of raises here in the guidance that was previously provided from back in July time. Darktrace's share price has been highly volatile, more than doubled in the last 3 to 4 months, where it's since peaked out and it's been on the decline. Right now it sits at £4.70 with a price to sales ratio of under 12, and I feel that this could be a good base point to start to build out a position. We've got 7 analysts covering this one with a mean consensus of an outperform rating and an average price target of £8.80, giving 88% increase from the current price. 3 buy ratings, 1 outperform, 1 hold, 1 underperform and 1 sell. And finally we have stock number 3. This is a company I did a separate video on about a month ago, and I'll link this up to the top just now, and I'd love for you to check this one out. But this company is IOMAR, and these guys are a data center cloud service company who own their own data centers and fiber infrastructure as well as offering cloud services. I think there's a compelling case here to own these companies for a few reasons. One, I think the current share price represents good value or for the potential for someone to complete a takeover. 2, it's in an important industry with good growth forecasts. And thirdly, IOMAR are currently in a transitional period where they've just got a new CEO in place. They're a small cap company, right now being valued at about £160 million, and over the long run has been a pretty decent performer up until 2019, where it looks to have topped out and it's been declining ever since. If you want to know more about why this is, then please check out the other video, but the long story short is that the results have been decent, but they did have a larger than normal customer churn rate recently. With this huge sell-off, you would expect revenue to be falling in the same manner, but interim results will be out December 7th and we'll get a better idea of how things are progressing. Yes, this company also pays a dividend, and if they hold it at the same rate as last year, this could be close to yielding over 5% shortly. As you can see, revenue has been slow and steady the last few years, and it's hit a bit of a pause throughout 2021. Assets outweigh liabilities, and IOMAR are sitting on £23 million of cash just now. Total debt has doubled since 2018, which although it isn't crippling, is still something to keep an eye on. Analysts aren't expecting things to improve, with revenue expected to be pretty range-bound out to 2024, but what makes this an interesting stock is what the CEO has to say on the growth. In their most recent earnings report, CEO Reece and Donovan outlined their strategic growth plans, and the section highlighted is what jumps out to me. This presentation concluded with an aspiration to become a £200 million revenue business in 5 years and be recognised as a leading secure hybrid cloud business. This aspiration of reaching £200 million is such a stark contrast to what analysts are expecting. Insider buying has been pretty evident over the last year or so, with the CEO himself, Reece Donovan, scooping up shares on numerous occasions, which shows that he believes within the company long term. And you've also got numerous other board members picking up shares too, all insider buying, no sells. For Iomat, we've got 5 analysts covering them, with a mean consensus of an outperform rating, 3 buy ratings, 1 hold, 1 sell, and 1 without an opinion. Price target of £3.11, giving a huge potential of 122% increase from current levels. So guys, that will sum up this month's picks. I hope you've enjoyed them, and please share your thoughts in the comments section below, and I'll catch you in the next video. Cheers!